Good evening, this is Money Matters. I'm Anthony Wilson.
And I'm Judy Canhai. Gyms are usually packed for the carnival period. But is this year different in light of people cutting back on how much they spend? We speak to a gym manager to find out. And a 25-year-old tells us why he chose to become a security guard straight out of secondary school.
But we begin with Marla Dukhanran, who is the chief economist at RBC Caribbean. She speaks about the state of the economy and also the possibility that TNT may be downgraded by Moodys. Welcome. How did the Trinidad and Tobago economy perform in 2016 and what is your outlook for 2017?
Well, thanks for having me, Anthony. The first thing I would say for 2016 is we know that there's been fiscal deterioration. The last budget articulated a deficit for around maybe 16 billion TT dollars. This is before the one-off items and capital transactions and so on, which, as far as I know, count as financing items, not as revenue items. We know that there was some external deterioration, meaning deterioration in our reserves, although reserves are still very strong. 10 months of imports or in excess of 10 months of import cover. And in my view, we know that we had an economic contraction for the first half of the year. The central bank said about 6.7. I'm guessing overall for the entire year, we would look at maybe a 6% overall contraction last year. So that's the three major areas around which we saw deterioration: fiscal, external, and growth.
The worst performance in the local economy in 30 years, you think?
In a very long time. I mean, I can't say off the top of my head what reserves were 30 years ago and what the fiscal deficit was 30 years ago, but in a very long time, as long as I can remember, certainly. But one thing that I want to suggest we might have also suffered that we're probably not talking about enough is the deterioration in our institutions and our governance. I mean, the fact that we cannot get this FATCA legislation passed, for example, speaks directly to that governance has weakened in my view. And the other point I want to touch on is our sovereign credit rating. So Moodys has us at a rating that is the lowest in terms of investment grade. So we're sitting on the threshold of non-investment grade, mm-hmm. right? In the parlance, we say junk, mm-hmm. right? And if you look at what Moodys assessed just about a year ago when they downgraded us, since then we've had external deterioration, fiscal deterioration, and in my view, institutional weakness as well, governance.
So are you predicting that Moodys and S&P are going to put Trinidad and Tobago into junk status?
Well, S&P has us at quite a few notches above junk, right? So
Moodys? What is Moodys going to do?
Moodys is actually here later this month to do their annual assessment is normally done around February, March. I would not be surprised if they downgrade us, because all of the metrics around which they measure us, the fiscal balances, debt, the sovereign wealth fund, which is our heritage and stabilization fund, external balances, and institutional weakness and institutional strength, and governance. Those are all the measures that they measure us on, and I can't say, and growth as well, of course. And I can't say that there's been improvement. Mm-hmm. So that would lead one to believe that there's a chance they can downgrade us to non-investment grade or junk, as we say.
And what are the consequences of a downgrade by one of the leading credit rating agencies?
Well, immediately the consequences can be with respect to the pricing and the yields associated with your government bonds trading internationally. So what would tend to happen is that investors will now demand a higher premium, risk premium, to buy the government's bonds, and they will demand a higher yield. So it's going to be more costly for the government to raise money in the external market, as well as it's possible that it can also affect the domestic market as well, because it speaks to your credit worthiness as a sovereign. That's what the sovereign credit rating speaks to. Yeah.
What about the rates that the government has been borrowing money on the local market in the last year and a half or so? The government has a bond out 4.1 over 8 years.
This is the 1 billion TT.
1 billion TT.
This one that came out, yes.
They did one in December.
Yes.
6 years.
Yeah.
3.9 from memory. Do you think that is a fair rate for TT dollar bond, given where the economy is at now?
Well, I wouldn't say whether I think it's a fair rate. I think what is important is that the market has to balance the creditworthiness of the sovereign, of the government, and also the amount of liquidity. And we still have excess liquidity in the financial system. It's declining, but we still have excess liquidity. So that's what the market will price. And so what is fair or not fair depends on those factors. They're pricing risk and they're pricing liquidity. If the market determines that 4.1 is not enough, well, then we will know because it won't be fully subscribed. Okay, so the result will tell us whether it's a fair rate or not.
Big question in Trinidad and Tobago at this point is the appropriateness of the exchange rate regime. What are your views?
Well, yes, that's something you and I have debated quite a few times. I think the regime is appropriate. We have a managed float. The way that it's being managed is, in my view, not appropriate right now. So what we have is an overvalued currency, as you know. I mean, the IMF has said that it should be valued anywhere between $8 and $10, depending on which model you use to calculate what is the fair value of the TT dollar versus the US dollar. And I've seen in the cambio in the airport up to Friday 8.7 TT dollars for $1 US. And that is a rate that is not, as far as I know, not regulated by the central bank. So it's a market determined rate for cash transactions. So that could also tell you that it is overvalued, the TT dollar, that is. So that's my first dissatisfaction, that the rate is overvalued. And what that means is that the central bank is subsidizing imports, basically, and penalizing exports. And when you're trying to promote diversification of the economy away from an energy dependence, so you're trying to get non-energy sector activity to increase, having an overvalued currency certainly is not the best thing. And also from an import perspective, if you're trying to save foreign currency outflows, which is what the governor of the central bank has said is his goal, because he sees this weakness in the oil and gas price and even production as more of a long-term problem, and so he's trying to hold on to reserves. Having an overvalued currency and subsidizing imports is counterintuitive, right? And contrary to trying to hold on to reserves. So I don't agree with the value, the rate that the US dollar is sold at, according to what the central bank dictates.
And obviously the central bank is managing the system by starving the market of
US dollars. So they're controlling price and they're controlling quantity, which, I mean, any basic economics textbook will tell you that that's a perfect recipe for a black market. That's what causes a black market, which I'm sure you know we do have. So that's my other concern. The rate that is overvalued, but also the quantity. So if you want to maintain your reserves and hold on to reserves because you think this is a longer term problem, I completely agree with that. That is the prudent thing to do. But then you cannot maintain an overvalued currency and starve in terms of suppliers, as you've just said. It just doesn't work. And at some point it's going to end up where the value of the currency of the TT dollar in real terms is already devalued because of the price it's being sold at, the US dollar is being sold at on the black market.
What is the solution for the government, for the central bank?
I think the central bank should allow more of a market-determined exchange rate. We used to have an auction element to our injection system years ago. And as far as I know, we do not have an auction element anymore. I
Interesting.
think it was removed under the previous governor. And I don't think it was, no, it was not reinstated. So what that meant was that the banks were allowed to bid according to what their demand was, what their queue was. And so there was an element of market determination in the rate, and we no longer have that. So I think that's one thing. We need to have more of a market determined rate and less of a regulated rate determined by the central bank. But I also think we need to be cognizant of the fact that, you know, controlling the supply and controlling and managing the exchange rate, first of all, the way we do now, is tantamount to having foreign exchange controls, which, as far as I know, we're signatories to Article 8 of the
Article
IMF,
8, yes,
and
yes,
we are not
yes,
supposed
yes,
to be
yes,
doing
yes,
these things.
yes.
So it's either you have a currency controls or you don't. And if you want to decide to have foreign currency controls, which we've had in the past, then all well and good. The thing is, everybody will know the parameters within which they operate. But when you officially don't have controls, but implicitly there are controls in effect, it leaves you in a position where you're uncertain about the policy stance of the regulator.
Great. Thank you
Yeah.
very much.
No problem.
When we come back, Judy speaks to gym manager about the financing of fitness for Carnival. Money Matters will be right back.